Day trading has become a popular pastime. Being stuck at home during the pandemic probably played a role, but the explosion in price from a handful of so-called meme stocks is what got everyone's attention. It was like a modern-day gold rush. In Canada, we even have our own mobile-first commission-free trading platform, making this pastime accessible to anyone with a smartphone and a few extra dollars. I made a video about day trading last year. I'll summarize my thoughts from that video in a minute. A lot of the feedback that I got when that video came out is that the papers I was relying on were too old to be relevant in the modern age of free trading and seamless access to information. It's true, many of my sources in that video predated the free trading and smartphone revolutions. I'm Ben Felix, Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you how technology has changed day trading. Last time I talked about day trading, I concluded, based on 6 published academic papers, that day trading is not a profitable activity for the vast majority of people, and that more frequent trading leads to a higher likelihood of poor performance. I also pointed out that individual investors tend to focus their trades on attention-grabbing stocks instead of rationally assessing the full global opportunity set, which increases the likelihood of trailing the market given the skewness in stock returns. Those papers, or the data on which they were based, were from a time before many of today's innovations. Watching stocks like GameStop and AMC go to the moon made it seem like there was a lot of money to be made in joining the online herd of like-minded investors. Fortunately, academic research has begun to investigate the effects of platforms like Robinhood that make trading more accessible to more people. Brad Barber and Terence O'Dean have authored a huge portion of the research on individual investor behavior. Their research has shown that individual investors underperform, sell winners and hold losers, are influenced heavily by attention-grabbing stocks and recent past performance, and they hold undiversified stock portfolios. In a 2020 paper, Attention-Induced Trading and Returns, Evidence from Robinhood Users, Barber, O'Dean, and 2 co-authors examined the RobinTrack data series pulled from Robinhood's API. These data allow researchers to view anonymized data for Robinhood users and analyze their behavior and performance. The researchers suggest that attention-influenced investors are more likely to exhibit herding behavior. As suspected, they find that 35% of Robinhood users' net buying activity is concentrated in only 10 stocks, compared to 24% for the general population of retail investors. They also find multiple herding episodes per day, where the number of Robinhood users owning a particular stock increases dramatically, and that herding behavior is predicted by measures for attention, like recent investor interest, recent extreme returns, or unusual trading volume. Finally, they find that during Robinhood outages, retail trading drops more in high-attention stocks. Chasing attention-grabbing stocks is nothing new for retail investors. It was documented by Barber and O'Dean in 2007. The effect of attention on buying behavior was documented as being more prevalent among new investors by Seasholes and Wu in 2007. This is relevant considering the influx of new investors attracted by free trades, fractional shares, and meme stocks. In their S1, Robinhood explains that nearly half of their 18 million customers were first-time investors. One of the things influencing the attention of Robinhood investors may be the trading interface itself, which shows the stocks of the day with the biggest price changes. Barber and O'Dean find support in the data for the idea that Robinhood's app design is impacting the trading decisions of its users. If the concentrated buying and selling that stems from attention-driven investors resulted in great returns, as the internet may have you believe, then this would be good news for retail investors. But this study finds that the top 0.5% of stocks bought on Robinhood every day lose about 4.7% on average over the subsequent month. This doesn't necessarily mean that Robinhood users are taking losses on these trades. They may be riding the herd up and getting out before the decline. The study authors looked at this too and found that the Robinhood community loses about 5% during each herding event, or 6% adjusted for market returns. The findings suggest that extreme herding causes negative wealth outcomes for the overall Robinhood community. The technological advantage of investors being able to band together through an easy-to-use app seems like it's making profitable day trading harder rather than easier due to the effects of attention on buying and selling behavior. The psychological impact of trading on a mobile app may contribute to the challenge for investors. A 2021 paper by Ankit Kalda and co-authors titled Smartphone Investing, a within-investor time analysis of new technologies and trading behavior, uses data from 2 large German retail banks that have introduced trading applications for mobile devices. The data are for over 18,000 bank clients, and it allows researchers to observe whether trades were placed on a PC or on a smartphone. The study authors find that the probability of purchasing assets with higher volatility and more positive skewness, in other words, lottery-like stocks with high probabilities of poor payoffs and low probabilities of great payoffs, increases in smartphone trades compared to non-smartphone trades. Specifically, they find a 67% increase in the probability of buying lottery-type stocks for smartphone users. They also find that smartphone traders hold more non-diversifying assets like individual stocks, and they're more likely to buy attention-grabbing assets like past winners and losers. In the German sample, the study authors find that smartphone trades trail the market by an average of 1% for the 12 months following the trade, while also having a lower average Sharpe ratio. So far, we've seen the effects of attention on investor outcomes. The social aspect of mobile trading may be doing more harm than good, but I think there's probably more to the story here. Everyone drinks more at an open bar. The perception of free trades may make people more inclined to trade more frequently, and this has been observed with Robinhood users who trade far more frequently than users of other discount brokerages. In the first quarter of 2020, Robinhood users traded 9 times as many shares as E-Trade customers and 40 times as many shares as Charles Schwab customers per dollar in the average customer account. A classic paper in the Journal of Finance by Barbara Nodine, titled Trading is Hazardous to Your Wealth, the Common Stock Investment Performance of Individual Investors, examines a dataset of 66,465 households with accounts at a large U.S. discount broker between 1991 and 1996. They find that individual investors are overconfident based on the empirical evidence that the average household earns a return close to the market before costs, but trails the market by 1.1% annually after costs. They trade to their own detriment, which is something that we would expect overconfident but unskilled traders to do. They find that the average household over this period tilts its portfolio toward riskier small-cap value stocks. Accounting for these additional risk exposures using the Fama French 3-factor model, the average household trailed a risk-appropriate benchmark by 3.7% annually. The average household in their sample turned over about 75% of its portfolio holdings annually, and the associated transaction costs explain their poor performance. The 20% of households in the sample that traded the most often, turning their holdings over more than twice annually, earn net returns that trail the market by 5.5% annually and trail a risk-appropriate benchmark by 10.3% annually. A 2009 study titled Sensation-Seeking Overconfidence and Trading Activity finds in a dataset from Finland that investors who are most prone to thrill-seeking and those who are most overconfident trade the most. All right, now those were old papers. Things are different now. There are no commissions, so turnover does not increase costs, right? Commissions are only one component of trading costs. The way that trades are executed can also make a significant contribution. In December 2020, the SEC charged Robinhood for misleading customers about their revenue sources and failing to satisfy their duty of best execution. It was determined that between October 2016 and June 2019, for most orders of more than 100 shares, Robinhood customers would be better off trading at another broker-dealer because the additional price improvement that such orders would receive at other broker-dealers would likely exceed the approximately $5 per order commission costs that those broker-dealers were then charging. For orders over 500 shares, the average Robinhood customer order lost over $15 in price improvement compared to Robinhood's competitors, with that comparative loss rising to more than $23 per order for orders over 2,000 shares. Nothing is really free. In Canada, we don't have payment for order flow, which was causing the issue I was just describing for Robinhood, but Wealthsimple Trade charges other fees, like a 1.5% currency conversion fee if you want to trade securities outside of Canada, which anyone trading based on attention is likely to want to do. This should not surprise anyone. Both Robinhood and Wealthsimple are valuable companies, which doesn't happen without a way to make profits from their customers. Trading always has a cost, even if you don't see it explicitly in your account. More trading increases costs and decreases net of cost expected returns. The last point that I want to make is related to market efficiency. Does the development of app-based herding break efficient markets? No, it doesn't. When Eugene Fama came up with the efficient market hypothesis, all he was saying was that prices reflect all available information. The EMH does not make a judgment on the information that is in prices. The information may be rational assessments by calculating investors, it may be irrational over or under reaction from biased investors, or it may be related to a preference unrelated to risk and expected returns for owning a specific stock. For making investment decisions, these differences in information origination don't matter much. Without making a judgment on how the information got in there, prices still contain information that can be used to assess differences in expected returns. Higher prices relative to business fundamentals mean lower expected returns, and lower prices mean higher expected returns. Trying to outsmart market prices is a losing game. Free trades have not made day trading any easier to profit from. If anything, free trading and the social nature of meme stock culture have increased herding behavior, preference for lottery-type stocks, concentration in attention-grabbing stocks, and frequency of transactions for the individual investors on these platforms. All of these things are detrimental to investor outcomes, especially for those thrill-seeking and overconfident investors who trade the most. Finally, the herding behavior of app-based investors is not breaking market efficiency. Market efficiency means that prices reflect information. It does not make a judgment on whether prices reflect rational assessments of risk and expected return, irrational overreactions, or preferences unrelated to risk and expected return. And it doesn't matter. Regardless of the information source, most investors cannot outsmart market prices. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital, and this is Common Sense Investing. If you enjoyed this video, please share it with someone who you think could benefit from the information. If you want more information like this, you can tune into weekly episodes of the Rational Reminder podcast on YouTube or podcast platforms.